Picture this. Silver launches like a rocket, tags a level nobody alive has ever seen in real time, and then collapses so fast it feels less like a market and more like a trapdoor. In the same window, you have a sitting U.S. president suing America's biggest bank, claiming the bank cut off his financial oxygen. Then the bank confirms, in writing, that yes, it did shut those accounts down. Most people treat this like two separate dramas. One is, commodities are crazy. The other is, politics is messy. But if you've watched the financial system long enough, you know something deeper. When a system enters late-stage debt saturation, the headlines stop being random. They start arriving in sequences. Not because of a secret meeting in a dark room, but because incentives become rails, and those rails force events to cluster. Here's the claim that frames everything you're about to hear. Once debt grows too large to be resolved through normal growth, the system has to shift from managing prices to managing exits. That's when markets become less about discovery and more about control. That's when collateral becomes sacred. That's when access becomes power, and the numbers are not subtle anymore. Global debt has been tracked around a record $348 trillion. U.S. total public debt outstanding has been recorded above $38.7 trillion as of mid-February 2026. Silver's London benchmark ran up to an all-time high of about $118 per ounce in late January 2026, then fell to the low 80s by February 2. That combination, record debt, violent metal volatility, and public fights over who gets bank access, is a system under stress, switching modes right in front of you. And to understand how abnormal that is, zoom in for 1 second. In early 2026, silver futures were up roughly 30% year-to-date, with analysts simultaneously describing a multi-tens of millions of ounces supply deficit, driven by industrial demand from AI data centers, electric vehicles, and semiconductors. That's the perfect cocktail for stress. Monetary fear meets industrial scarcity. So when silver spikes and whipsaws, it's not just traders gambling, it's the system revealing where the pressure is building underneath. Now here's the inevitability statement, because this is where denial breaks. A debt-saturated system always ends the same way, because the math allows only 3 exits: default, inflation, or control. Default is politically lethal. Inflation without controls triggers mass escape. So the system drifts toward control, over the rails, over the settlement rules, over who can transact freely. Not because it wants to, because it has to. If that sounds extreme, good. Hold on to that skepticism. I'm not asking you to believe me. I'm asking you to test a mechanism, because once you see the mechanism clearly, you'll stop being surprised by so-called random shocks, and you'll start seeing the sequence before the headline. Here is the mechanism, a 4-stage pattern, a machine that repeats across centuries. First, a system is built on a promise: convertibility, stability, neutrality, safety. This is the foundation stage. It lowers fear and raises participation. People opt in because the promise feels solid. Second, the system expands claims faster than it expands real resources. Credit grows, leverage grows, paper claims multiply. This is the overextension stage. It feels like prosperity because the bill hasn't arrived yet. Everyone benefits from the expansion, so no one wants to question it. Third, reality arrives as a constraint. The constraint can be reserve drain, inflation, collateral shortages, a geopolitical shock, a run on deliverable assets, or simply a sudden crack in confidence. This is the crisis stage. The system can no longer keep the original promise for everyone at the same time. That is the critical phrase, for everyone at the same time. Fourth, the rules change. Money is redefined. Settlement is redesigned. Enforcement activates. Scapegoats appear. The winners are the ones who controlled collateral and access before the shift. This is the outcome stage, and the people who lose are always the ones who assume the old rules were permanent. You don't have to like this pattern, but you do have to respect it. Because it's not political, it's structural. Now let's prove it. 3 case studies, 3 different eras, same 4 stages, same outcome logic. Start with the post-war order: Bretton Woods, the London gold pool, and the moment the promise breaks. After World War II, the world needed stability. Bretton Woods was the architecture. Dozens of nations agreed to managed exchange rates, with the US dollar at the center, linked to gold at $35 an ounce. That link was the promise. It said, dollars are not just paper. They are anchored to something real and finite. Then came expansion. The world needed dollars to trade and rebuild, and the United States discovered the hidden power of issuing the reserve currency. You could create claims that the world would accept, while the gold behind the promise did not grow at the same speed. The gap between obligations and reserves widened year after year. Nobody moved to close the gap because closing it meant accepting pain, and no political system voluntarily accepts pain when it can export it forward. What does a system do when the gap grows too large to hide? In early phases, it tightens. In late phases, it manages appearances. And that is exactly why the London gold pool matters. In 1961, major central banks coordinated gold sales and market interventions to defend the official $35 price. In plain language, the system tried to suppress the warning signal. Let me make that visual. Imagine a pressure cooker with a gauge. The gauge starts rising. Instead of lowering the heat, you hire 8 people to stand around the gauge and push the needle down with their fingers so the public doesn't panic. That's what coordinated intervention is when the underlying mismatch is never addressed. It buys time. It does not buy a solution. By 1968, the pressure became too high. Runs on gold intensified, confidence cracked. Authorities temporarily closed the London gold market and moved toward a 2-tier system: official transactions at the old price, private markets at whatever price reality demanded. The promise was splitting in half publicly in front of the world. Then August 15, 1971, Nixon closed the gold window. Foreign governments could no longer redeem dollars for gold. The promise died. The institutions survived. And the world entered the modern fiat era, where claims could expand far faster because the anchor was gone. They called it modernization. What it actually was: the system broke the promise to save itself, then rewrote the rules and named the rupture progress. That's case 1. Now case 2. Weimar Germany and the return of collateral. People think Weimar is just printing goes brr. That's the meme version. The mechanism version is more useful to you. The setup stage is trust in the currency as a social contract. A unit of account only functions if people believe it will carry value long enough to plan their lives. When that belief is intact, the system hums. When it cracks, everything cracks with it, because everything is priced in the currency. Expansion arrives when the state chooses immediate solvency over long-term credibility. War finance, post-war reparations, fiscal gaps. Printing becomes the bridge across each crisis. And because printing delays pain today, it creates more pain tomorrow, which makes more printing necessary. Expansion becomes self-feeding. Each round of new currency erodes trust, just enough to require the next round. Then crisis. In 1922 and 1923, the papermark collapsed. But understand what hyperinflation actually is, because most people misread it. It is not merely prices rise. It is that time breaks. You cannot store value. You cannot plan. You cannot trust that the number in your account tomorrow means the same thing as the number today. Velocity explodes because holding the currency becomes a guaranteed loss, so everyone moves it as fast as possible, which accelerates the collapse further. Then the outcome. In November 1923, Germany introduced the Rentenmark to halt the spiral. And here is the part that gets missed in every casual retelling. The Rentenmark was not backed by gold. It was backed by mortgages on land and industrial assets, real collateral that could not be printed at will. Trust returned not because speeches improved. It returned because the system reattached money to something scarce and enforceable. The lesson that connects to today is this: in the outcome phase, systems do not become freer. They become more collateral-based and more controlled. Emergency demands an anchor, and anchors require enforcement. Whoever controls the collateral controls the reconstruction. Now case 3, Silver Thursday 1980, when the rulebook became the market. This one matters most for today, because it shows how fast the rules can change when a metal becomes a threat to the institution. The setup stage was the 1970s environment. After the gold window closed, inflation and uncertainty pushed people toward tangible hedges. Silver became both a monetary store and a tradable instrument in futures markets. The implicit promise was fairness. The exchange is a neutral arena, and price is genuine discovery based on supply and demand. Expansion arrived through leverage and concentration. The Hunt brothers accumulated enormous exposure to silver, including massive physical holdings in futures positions. As price rose, leverage rose. As leverage rose, the market's stability began depending on that one-sided concentration remaining intact. And that is always the danger in expansion. The system becomes fragile because the winning position is too large to unwind quietly. Then crisis. In January 1980, COMEX adopted what became known as Silver Rule 7. Buying on margin was restricted, leverage mechanics were tightened. Once the rules changed, the credit that was supporting the position evaporated almost overnight. Margin calls hit. Liquidations cascaded through the system. On March 27, 1980, Silver Thursday, the price collapse triggered panic across commodity and futures exchanges simultaneously. Then the outcome: enforcement, significant losses, and a scar in market memory that professionals still reference today. The message was unmistakable. When a market threatens systemic stability, the rulebook can change mid-game. And if your position depends on the old rules, you can be completely right about the underlying story and still be destroyed by the mechanics of how it settles. 3 eras, different triggers, identical stages, promise, expansion, crisis, outcome. Now we apply it to the present, and this is where the analysis becomes personal. Start with the setup stage today. The modern promise is not redeemable for gold. The modern promise is institutional competence and neutrality. It is the belief that banks are safe, payments are neutral, and access to the financial system is essentially guaranteed if you are a normal participant. Your bank account feels like a right, not a privilege. That feeling is the promise. And like every promise in this pattern, it is conditional. Now look at the Trump and JPMorgan lawsuit. In early 2026, Trump sued JPMorgan and its CEO, Jamie Dimon, for $5 billion, alleging the bank closed his accounts for political or reputational motivations following January 6th. The key point here is not your opinion of Trump. The key point is that JPMorgan acknowledged in court filings that it did close accounts tied to Trump after January 6th. That single fact should shift how you think about money. Because money is not only a number, money is the ability to move the number. If access can be revoked under a category as broad and elastic as reputational risk, then money is permission. And permission is a lever, one that someone else holds. Setup stage confirmed. Access is not neutral. The promise is conditional. Now expansion stage today. The macro expansion is obvious. Global debt near $348 trillion, U.S. public debt above $38.7 trillion. That is a world where obligations must continuously be rolled forward. A world where the system cannot simply stop expanding without triggering contraction pain that no sitting government will accept. So it keeps expanding, and the gap between claims and real resources keeps widening, just as it did before every prior crisis in this pattern. But expansion also has a micro layer, the multiplication of paper claims on commodities, futures, options, unallocated metal, ETFs, swaps, claims stacked on claims. In calm markets, paper exposure feels liquid and reliable. In stressed markets, paper becomes a question. Can it settle? Can it deliver? Can it exit cleanly when everyone reaches for the door at once? This is where JPMorgan's precious metals history becomes relevant, not as scandal, but as signal. In 2020, U.S. regulators announced a $920 million resolution, with JPMorgan related to unlawful trading activity in precious metals futures and U.S. Treasuries markets. You can frame that as enforcement. You can frame it as accountability. What you cannot call it is imaginary. It tells you that market microstructure, the way orders are placed, prices are nudged, and liquidity is managed, can be influenced by the largest institutions in ways that retail participants never see in real time. Expansion stage confirmed. Debt claims expanding at the macro level. Pricing influence at the micro level. Both verified. Now the crisis stage today. This is where silver stops being a trade and starts being a stress sensor you cannot afford to ignore. The LBMA silver price climbed roughly 60% from January 2nd to reach an all-time high of $118.45 per ounce, then dropped sharply to below $82 by February 2nd. A 60% surge followed by a 30% collapse in roughly 30 days. That is not ordinary price discovery. That is a market under extraordinary tension, revealing the stress fractures in the underlying system. And you need to understand why silver behaves this specific way in late-stage systems. Silver sits on the fault line between monetary memory and industrial reality. In fear, it trades like money. In growth, it trades like an industrial input. In an era of electrification, AI infrastructure, electric vehicles, and geopolitical supply chain restructuring, silver becomes simultaneously a hedge against monetary dysfunction and a critical manufacturing input. That dual identity means it attracts pressure from two directions at once, and when both pressures spike simultaneously, the volatility is not a glitch. It is a reading. Now combine that volatility with the access fight happening in parallel. When volatility goes vertical, institutions de-risk. They tighten credit. They raise margin requirements. They increase compliance friction. They close accounts deemed problematic. And here's the hidden part. The definition of risky expands during stress. It absorbs financial risk, regulatory risk, reputational risk, and political risk all at once. In a crisis phase, risk becomes a flexible category that can be shaped to serve institutional interests. So while retail investors are debating whether silver's move was a bubble or manipulation, the system is doing something more consequential. It is deciding who gets to remain on the financial rails during stress. That decision is being made quietly through policy language and compliance decisions, not through headlines. Crisis stage confirmed. violent collateral volatility and open conflict over banking access simultaneously in the same window. Now the outcome stage forming right now. And this is the part I need you to stay with, because the outcome phase almost never looks like a Hollywood crash. It looks like paperwork. It looks like a policy update. It arrives dressed as for your safety. The outcome moves in three directions at once. First, collateral consolidation. In late-stage systems, deliverable assets become strategic. Not because institutions suddenly develop philosophical affections for precious metals, but because collateral is what stabilizes balance sheets when trust wobbles and counterparty risk rises. When the system tightens, the incentive is to accumulate what cannot be printed, especially when the public is distracted, exhausted, or focused on the political theater surrounding the economic event. Second, access consolidation. If debt must be managed through sustained inflationary drift, the system cannot allow mass escape into untracked or unregulated channels. It needs economic activity to remain inside monitored rails. That means more risk scoring, more compliance requirements, more transaction monitoring, more selective service. Debanking in this context is not an accident or an overcorrection. It is a mechanism for shaping behavior at scale. It creates friction precisely where friction is useful to the institution. Third, legal codification. In the outcome phase, disputes migrate from private policy to public litigation and legislation. The Trump lawsuit is not just about Trump. It is a test case for whether banks can revoke access based on broad reputational criteria and whether that power can be challenged or constrained through the courts. No matter how that specific case resolves, it is forcing the question into public record. Access is becoming political, and once it becomes political, it becomes negotiable, which means it can be withdrawn. Outcome phase forming, collateral consolidation, access consolidation, legal codification, all three moving simultaneously. Now let me give you the single sentence that compresses everything you've heard into something you can carry with you. The end game is not about the price of silver, it is about who controls settlement and permission when the system is stressed. If that sentence makes you uncomfortable, it should, because most people have built their financial lives on an assumption that is not guaranteed, that the rails will always be open to them. Think about what that means practically. If you run a business, your bank account is not a savings jar, it is your bloodstream. Payroll, rent, suppliers, taxes, card processing. If that account is closed with minimal notice, the business can be fatally damaged within weeks. And even if you are personally wealthy, you may not be liquid enough, across enough rails, fast enough, to replace that access before the damage is done. That is why the JPMorgan case matters to people who have nothing in common with Trump politically, because the mechanism does not care about your politics. It cares about whether you can be classified as a risk at a moment when the institution needs to reduce its exposure. And the same logic applies to investing. Imagine you buy silver exposure because you correctly read that debt and inflation should push metals upward. The thesis is right. Then volatility explodes, margin rules tighten mid-move, your broker changes requirements, and your position gets liquidated at the exact wrong moment. You were right on the analysis and wrong on the mechanics. That is how most people lose in crisis phases, not because they misread the signal, but because they underestimated how quickly the rules of the game could change around a correct position. So here is the practical framework. Two risks exist in this era, and most people only manage one of them. Price risk is visible. Silver can move like a weapon. Equities can gap. Currencies can break. Most investors have some mental model for price risk, however imperfect. Permission risk is silent. Permission risk is the rule change, the account closure, the settlement shift, the sudden liquidation-only regime, the compliance hold that arrives without warning. Permission risk is why sophisticated participants care deeply about custody, deliverability, counterparty structure, and redundancy. And it is why retail investors consistently learn this lesson at the worst possible moment, when the cost of learning is highest. So here is how you run a system check every time you see a headline, so you don't get emotionally redirected by the framing. Ask 3 questions. Is this headline about collateral, metals, energy, land, strategic reserves, real assets? If yes, it signals the system is fighting over what is real versus what is paper. Is this headline about rails, banks, payment systems, account access, compliance regimes? If yes, it signals the system is fighting over who gets to participate. Is this headline about rules, margin changes, emergency policies, settlement adjustments, legal battles over access? If yes, it signals we are in the transition from crisis to outcome. If you answer yes to all 3 in the same time window, collateral, rails, and rules simultaneously, you are watching a system reset in progress. That is not a vibe or an interpretation. That is a pattern with a historical track record spanning centuries. Now, the comforting lie that appears in every era without exception, This time is different. People said it before Bretton Woods collapsed, because America was strong and the architecture was modern. People said it before Weimar, because they believed the state would never allow the currency to die. People said it before Silver Thursday, because they trusted the exchange would never change the rules during an active market. The tools were different every time. The constraints were not. Debt is a constraint, collateral is a constraint, trust is a constraint, and when constraints tighten, power consolidates toward whoever controls the choke points. So here's what you actually do with this. Design your life for redundancy. One bank is a single point of failure. One payment processor is exposure. One brokerage means you are entirely dependent on that institution's rule set during the next stress event. Redundancy is not paranoia. It is the same logic that engineers use when designing systems that cannot be allowed to fail. Reduce leverage. Leverage is the primary reason people get destroyed even when their thesis is correct. In expansion, it feels like acceleration. In crisis, it is a mechanism that hands your position to someone else at the moment of maximum stress. Separate price exposure from actual possession. If your silver is a paper claim, understand the terms precisely. Is it allocated or unallocated? Who is the counterparty? What are the redemption rules? What happens if the market goes to liquidation-only mode? You don't need to become an expert in metallurgy. You need to become a careful reader of contracts and custodial agreements, and watch the rails as closely as you watch the price chart. The most important signals in the next phase will not be candlestick patterns. They will be rule changes, compliance language shifts, legal precedents, and regulatory decisions about what constitutes a valid reason to deny service. When a court or regulator pushes back on reputational risk as sufficient grounds for debanking, that is not a culture war footnote. That is the system negotiating how much open control it will be permitted to exercise over access. Let's close the loop we opened at the beginning. Silver's violent move and the Trump lawsuit are not separate stories that happen to occur in the same news cycle. They are symptoms of the same underlying transition. Silver is signaling that collateral is becoming contested. The lawsuit is signaling that access is becoming conditional. Debt is the fuel that forces the transition forward regardless of who is in office or what the official narrative claims. And institutions sit at the center because institutions control the plumbing that everyone else depends on. The final point is simple, and it does not have exceptions. This pattern does not care who you vote for. It does not care what you believe about markets, politics, or economics. It runs as long as debt must be managed and constraints must be enforced. Every era that has gone through this transition produced the same result. Those who understood the mechanism adapted. Those who assumed the old rules were permanent did not. The next stage is not a cinematic crash. It is a rulebook revision. It is a settlement protocol update. It is a compliance shift that quietly redefines who qualifies for normal access. It is a legal precedent that converts informal permission into explicit policy. The question is not whether you will be affected. The question is whether you see it clearly enough, early enough, to position yourself on the right side of the transition before the rules are finalized.